Conversation. We're going to bring in Wamsi Mohan, senior analyst at BofA Securities, and Chris Retzler, Needham Growth Fund portfolio manager, she said. Welcome and good morning to you both. Chris, I'll start with you. The sell-off we have seen pretty broadly within some of these different tech names. What would you attribute that to?
So I think that tech is going through a corrective phase. There's rotation within the market. Higher inflation expectations have caused, a steeper interest rate curve on the long end, and that depresses valuation multiples. So I don't think it's something to get concerned in the long term, but we are seeing money flows that are rotating. And for longer term investors, we think that there's going to be some great opportunities that are going to present themselves. But I think you have to be patient. We've talked about semiconductors here, and it's really facing a perfect storm on the supply chain side of things. And it's going to take time to correct. But I wouldn't give up on technology. They've got really good growth rates. But right now, things like oil and financials are doing better. But we like better balance sheets than most of the energy companies out there. So
you see this as more almost just this broader rotation into more cyclical stocks, a reversion to the mean, if you will, rather than concerns about rising rates or even capital gains tax increases?
I think it's more combined with rising rates, which ultimately I think should correct itself. Inflation is here. It's across multiple areas. But when I look out a year, is that something that's going to be continued? And I think it's more episodic here that we get through this, and then the market corrects itself that way.
Wamsi, I mean, it wasn't that long ago that it was as go Apple, so goes the broader market. And yet, when you look at the year-to-date performance, it's down slightly. It's underperformed the Dow, the S&P, even the NASDAQ. What would you attribute that underperformance to? And is there an opportunity, given where we're seeing shares trade?
Yeah, thanks for having me. You pointed out rightly that shares of Apple have lagged the broader market. And this underperformance is quite notable because typically when Apple goes into a big product cycle like 5G, shares outperform. You actually saw a huge outperformance of Apple over the last 2 years. If you look at sort of both the 2018 and 2019 timeframes, the outperformance was very, very significant. You had 2 years of like 80% returns, which was maybe 60 points of outperformance. So an underperformance over here is somewhat to be expected when you're hitting these really tough comps, when you're hitting, the best numbers that you have posted in a very long time for 2 quarters in a row, and yet the stock underperforms. It's a telltale sign that investors are looking to earnings growth for the following year, and we're actually modeling calendar 22 numbers down versus 21, 23 roughly flat versus 21. So you've got 2 years of challenging growth, which I think is the main concern in investors' minds as they look to other names potentially that don't have those that sort of an overhang.
Chris, a few moments ago, you just said that you're seeing or you expect to see opportunities. What are they right now?
So I think one area that investors should be really taking a hard look at is semi-cap equipment. There's clearly national interest to build out our manufacturing and to bring that back home. We are seeing that from the primary manufacturers that are looking. We also potentially have infrastructure coming in from our government that supports that as a strategic national security reason. And we think that that's going to bode very well for semi-cap equipment manufacturers. Currently right now, I think that they're still trying to ramp up their production. They've been producing as much as they can, but we think that that's going to continue. So that would be an area that over the next quarter or so, I would be looking as an investor.
Wamsi, you've got a good note out on Apple this morning. You talk about the tough compares starting to hit the product line in the December quarter, but man, some of these App Store comps are already there.
Yeah, Carl, exactly. That's right. Like when you think about the tough comps hitting the services segment, last year during the height of the pandemic, there were exceptionally high download rates around the App Store. The usage of services really skyrocketed, and you're seeing the flip side of that already. When you look at numbers in April, you're comping 30% growth versus a year ago, and now you're growing mid-teens. And that's a huge deceleration. So when you put that in the context of what you're going to get over the next several quarters, it just limits the upside. And then you've got the added risk of regulation and taxes and everything else. But the drivers of upside get capped when you comp these really gigantic numbers, and services is the first sign. And you're seeing that more broadly across all these stay-at-home beneficiaries from last year that really did quite well last year, but now are comping those, and you see all sorts of metrics on active usage and downloads starting to decelerate. And I think that's the same thing that's happening at Apple. Not to be, it's not unexpected by any stretch of the imagination, but those are the law of large numbers here in a very profitable services business that is going to decelerate over the next few quarters.
Shepard Smith here. Thanks for watching CNBC on YouTube.